In this video, I'm going to explain very briefly what is cost of capital. The cost of capital is also called weighted average cost of capital or the composite cost of capital in finance. Before I go and explain the concept of cost of capital, I would like to give you a snapshot of different sources of capital because the cost of capital depends on the source of capital. So here I have given you the broad overview of different sources of capital. I started with the non-asset based financing. The non-asset based financing basically refers to any kind of financing source which does not require collateral. So for example, it could be line of credit or term loan. The second kind of the source of capital is asset-based financing, which means any sorts of loan or financing sources which requires collateral. And if it is a running business, you can always get loan based on inventory or receivables as a collateral. If it is like private company which is not up and running yet, then you can use the building or the real estate, some other sorts of assets as a collateral. So we have the third source of capital, which is more recent, and I have labeled this as a financing through social networking, which includes peer-to-peer learning and crowdfunding. And if you want to know more about any of these sources of financing, you can obviously start Googling and read some other sources, but I just want to give you here the uh, overview of different sources. And the fourth source of capital basically refers to here large strategic investors, which I refer to like angel investors, private equity firms, or big venture capitalists. These are the investors which usually provide startup capitals or the capital companies need towards the beginning of their life. And they look at different factors, and most often they look at the probability of success and probability of expanding to a large business. And I have the fifth sources of capital, which is IPOs and SEOs. IPO refers to initial public offering and secondary market equity offerings. Here, SEOs. So IPOs basically means if you are a private company and you want to collect capital issuing stocks, selling stock to the public, so how are you going to collect them? What are the cost and benefit? Those are the things. So SEOs basically means if your business is already running and you need some capital to grow, then how can you sell the equity in the secondary market and raise capital? So this is one of the most widely used sources of capital for well-established, already running firms. And finally, I have the bond financing, and these sorts of financing source mostly available for well-established, up and running businesses which can use their name and brand to collect or to raise capital from the general public. So these are the broad different sources of capital. And based on these different sources, what is the WACC or the weighted average cost of capital? The weighted average cost of capital is basically the average cost you expect to pay your capital provider. That's what the cost of capital or weighted average cost of capital is. Now, in the next slide, I want to provide you a very simple, intuitive example. For example, like you want to buy a truck to use in your business, and the truck costs 20,000 in everything inclusive, and you don't have any cash to buy this truck. What you are going to do is you're going to use 15,000 from the bank loan, which offers you the loan at 7.49%, and you're going to use 5,000 from your credit card. So in that case, what would be the financing cost of this truck then, right? So let's see how we calculate the financing cost of this truck. And general formula to find the cost of capital or weighted average cost of capital is, this is how you calculate. First you calculate after tax cost of bank loan and multiply this by the proportion of the finance that is being financed through bank loan, and then you calculate after tax cost of credit card loan and you multiply by the proportion of the finance being financed through credit card. And if you multiply all these and sum this all, then it gives you the cost of capital or the weighted average cost of capital. So now obviously after tax cost of capital plays very important role in calculating cost of capital. So we need to understand this uh, as much as possible. That's why I'm going to explain the next slide. How do you calculate after tax cost of loan or the debt? I have designed a very simple example. In this example, you need $100 this year to make an investment, and you can borrow that $100 at 10% interest. And if you make that investment, you're gonna get $200 after a year, and the tax rate is 20%. So let's compute the after tax cost of this loan. So let's assume there is no loan. How much tax would you pay? $200 is your cash flow and 20% tax rate, so you're gonna pay $40 for tax. So if you have a loan, what happens? Let's see. You have $200 as a cash flow and 10% interest. So on your loan amount 100, the interest is going to be 10. So remember that the interest you pay on loan is tax deductible. That's why your taxable income is going to be your cash flow 200 minus 10 is 190. Now the tax is calculated on that taxable income, which is 20% of 190 is going to be 38. Now compare, if there was no loan you would pay $40, and if you take loan the total tax you would pay is 38. So there is some saving on tax if you finance your project borrowing money. How much did you save here? So 40 minus 38, obviously $2, right? So that $2 is a tax saving because you finance this project borrowing money, not your cash. So in this case, what is the actual interest did you pay then? So $10 is the interest you pay to your loan, but the $2 is saved from the tax, so you paid only $8 for your $100 loan. So what is the actual or after tax cost of debt then? So you calculate $8 interest for 100, it's going to be 8%, and that can be calculated as interest on loan times 1 minus tax rate. This is how you calculate after tax cost of debt. So please always remember this simple technique to find after tax cost of debt, which is you multiply interest rate on the debt or the loan by 1 minus tax rate. So after we understand how to calculate after tax cost of loan, now let's continue with our example. And as you know, in this example we have a truck we have to buy and it costs 20,000, and I'm making an additional assumption, right? There's a 20% tax. So how do you calculate now the cost of financing this truck? Remember the formula here. So now the cost or the weighted average cost of capital is going to be 7.49% is the interest rate you pay on the bank loan times 1 minus tax rate times the percentage of bank loan, and similarly 12.59% is the interest on credit card, and 1 minus tax rate and percent of credit card loan. So when you multiply interest rate with the 1 minus r, then you get the after-tax cost of loan. So that's why the first portion this here is the after-tax cost of bank loan, and the second portion right here is the after-tax cost of credit card loan. And if you make the calculation, then the total is going to be 7.012. This is how you calculate the weighted average cost of capital. Next, what I want to do is I want to show you this in Excel, how to do this in Excel, because that's what we are going to use ultimately. So in this Excel here, I have written all the information from the problem. Now, how do you calculate cost of capital in Excel? Right here, please look at how I have organized the information, and this is how you are going to follow for all the problems or all the situations. So see, the first is funding sources, then loan amount, percent of loan, interest rate, after tax cost of debt. Finally, you multiply after tax cost of debt with the weights. So let's just start very briefly the bank loan. What is that? This is the 15,000, right, that you're getting, and credit card loan is obviously the 5,000 you're getting, and your total loan is 20,000, which is the sum of these two, right? Now, how do you find the percent, right? So this is the bank loan over total. That gives you the 75%, 5,000 over 20. So right here, and interest rate, that's the bank interest rate, which is 7.49%, and for credit card you have 12.59%. Now after that, now you have to calculate after tax cost of debt. And how do you calculate? Simply this, remember, the interest rate times 1 minus the tax rate gives us the after tax cost of debt, right? So similarly, for after tax cost of credit card loan, you multiply interest on credit card by 1 minus tax rate. So when you do this, now you have after tax cost of debt. So finally, what you have to do is you multiply the after tax cost of debt with the weights, right? So once you multiply that, you can definitely copy it. And now if you sum this two, sum of these two, that gives us the weighted average cost of capital or financing cost of this truck. So I would like to say WACC for this problem is 7.012%. This is how you calculate WACC in Excel. Remember again the format, we are going to use this kind of setting for all the remaining problems. Now I want to go back to our slides. We have here broad outline for calculating the weighted average cost of capital, and we discussed different sources of capital, but remember all these different sources of capital can be divided into three categories: debt, equity, and the hybrid. Debt, basically you borrow; equity, you give the ownership; and hybrid, some sorts of both. It includes the borrowing feature as well as the equity. And this hybrid I'm not going to discuss in our class, so I'm going to exclude this right here. So let's assume now you have only two sources of capital, debt and equity. How do you find the cost of capital or weighted average cost of capital? In this case, the average cost of firm expects to pay its debt holder and equity holder. That is what the weighted average cost of capital is. So let's see an example, and in this example you need $10 million for expansion, and the tax rate is 32%, and you are going to finance this capital need using debt and equity. And out of this 10 million, 6 million you're going to finance through debt and 4 million finance through new shares or equity, right? And the cost of debt is 6%, and cost of equity is 12%. How do you know? Right now, just take it for granted, but in the next few videos, I'm going to explain how to calculate cost of debt and cost of equity. Now, in this case, how do you calculate weighted average cost of capital? So, the simple way, remember the formula, right? So, weighted average cost of capital is going to be your cost of debt times 1 minus tax rate times the percent of debt financing and cost of equity times the percent of equity financing. So if you simplify that, it's going to be 7.25%. This is what the cost of financing this expansion is. So I think I explained you the briefly what is the weighted average cost of capital. Now I want to give you a broader picture here and a general formula. So remember here, sources of capital, broadly debt and equity, and how do you calculate WACC? Remember here, after tax cost of debt times percent of debt financing, after tax cost of equity times percent of equity financing. So I would like to give you a general outline how you calculate the weighted average cost of capital or the composite cost of capital, and I have listed here 4 general steps. Step 1, what do? You calculate the target proportion of debt and equity, meaning what will be the capital structure of the firm after you finance the project. So what proportion of debt, what proportion of equity? That's the first step. Second step, once you know your target capital structure, then you go and calculate cost of debt. Next you calculate cost of equity, and once you calculate all the above 3, now you can put all of these like shown in formula and calculate weighted average cost of capital. So in the next few videos, I'm going to explain how to do each of these steps, and don't forget to watch them. Thank you.